Good morning. Welcome to Stock Market Today for Wednesday, February 24th, 2021. This is your host, Dan Russo, the Chief Market Strategist at Chaikin Analytics. You can find me on Twitter. I'm at @DanRusso_CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to chaikinanalytics.com/today. Sign up for a free email where I get a lot of the content for this show. We also give you daily stock ideas to consider, and it hits your inbox every trading day before the market opens. So let's dive right in. Yesterday was a bit of a wild day, but you wouldn't know it if you weren't paying attention and only looked at closing prices. U.S. equities closed mixed, but ended near the highs of the day after a morning sell-off. The S&P 500 broke a 5-day losing streak, while the Nasdaq 100 was down for a sixth consecutive day. At the sector level, energy and communication services led, while discretionary and technology lagged. Treasuries were mixed, with the curve steepening. The dollar was stronger on the yen and euro crosses. Gold finished down 10 basis points. WTI crude was roughly flat on the day. Now, as we get to the desk this morning, S&P futures are up about 10 basis points. It's a little mixed, though, across the board. That's after Asian markets came under pressure overnight with a roughly 3% sell-off in Hong Kong on concerns about a share trading stamp duty. European markets are higher. Treasuries are weaker across the curve. The dollar is higher against the yen, flat on the euro cross. Gold is slightly better. Bitcoin is back above $50,000, and WTI crude is up 80 basis points to kick us off midweek on a Wednesday. That starts off with the SPY and Qs having held support. Now, we've been outlining these support levels for some time, actually been bumping them up a little bit. Support 370 to 380 range for SPY was tested yesterday. A lot of pressure. Some of what we were talking about, higher rates and the impact, especially on growth stocks. Take a look at the Qs in the middle of the chart there, really pulling back to test that 315 to 320 support zone. IWM was down, but has withstood the selling pressure a little bit better. IWM support remains in the 200 to 210 range, then 160 to 170 below that. So we're holding the ranges so far, and that's positive, right? Ideally, we want to see a rebound. Now, what this has done over the past week or so is alleviate some of those overbought conditions that we have been talking about in our notes and in our calls and on shows like this. So it's potentially setting up some opportunities on the long side of the portfolio. Obviously, we want to continue to pay attention to interest rates as we always do. That seems to be the key driver of some of the volatility over the past week. Again, Nasdaq 100 down 6 days in a row. The SPY was down. The S&P 500 was down 5 days in a row before snapping back yesterday. So a little bit of volatility here in the near term as investors are beginning to digest what higher interest rates could potentially mean for different pockets of the equity market. Thus far, however, the trend is up until proven otherwise, and we continue to outline the roadmap as we've been doing day in and day out. Let's take a look at our market in a minute now. What are we writing about in the note today? Well, early weakness on rising rate fears gave way to a rebound, and that was largely a function of Chairman Powell's comments. Chairman of the Fed, Jerome Powell, speaking in front of Congress yesterday and reiterating his lower for longer stance on rates, maybe kind of soothed some fears that rates could go too far too fast to the upside. If you do look at a chart of the 10-year Treasury yield, you can see that we're trading very close to the bottom end of a support zone at around the 1.45 level. So resistance zone, resistance zone. So that's interesting. But again, it's impacting different pockets of the market, right? So while rising rates and a steepening yield curve have been a benefit for things like banks, large cap growth not taking it as well. And that fund, IWF, is beginning to lag once again. Sentiment is largely unchanged on the week. And as I said, futures point to a bit of a mixed bag here on the opening. So as I said earlier, if you just kind of looked at closing prices, you wouldn't think much happened yesterday. But the morning sell-off was violent, especially in the high multiple, high growth stocks. The Dow roughly flat on the day, 8 to 5 bulls to bears there. S&P tax on 13 bips, 145 to 52 on that ratio. The Nasdaq was down on the day, 23 to 16 bulls to bears. Small caps underperform, down close to 90 basis points, 760 to 157 as that ratio begins to moderate a bit. Bonds down, tick sending yields higher. And that's kind of been one of the big concerns for the growth stocks. Energy, once again, your leading sector, 4 to 1 bulls to bears after energy adds 1.65% on the day. According to the Chaikin Power Bar, small cap stocks and large cap stocks are strongly bullish. Now, let's see our stock of the day now. I do think, as I said, the sell-off, the alleviation of overbought conditions starts to open up some opportunities. And ECOM, ChannelAdvisor, starts to look a little bit compelling to me here as a potential idea. It's a bullish rating here at Chaikin Analytics. The trend is strong above that rising long-term trend line. And it's in the software space, which is a strong industry group. Now, what's interesting to me here is we recently had this shift where the stock goes from being an underperformer to improving to now being an outperformer. So recent change in the relative performance of ECOM. Stock has moved into an oversold position. So what I see is a breakout and a pullback that retests and holds that breakout level at around $22. That's an interesting dynamic to me. All the while, Chaikin Money Flow remains bullish and intensely bullish, right? It's kind of moving in the right direction. So if I'm thinking about ideas, if I'm thinking about the fact that markets are no longer overbought and looking for potential opportunities, yesterday may have provided some setups that are interesting along the lines of something like a ChannelAdvisor here. Take a look at ECOM, down 2% yesterday, bullish stock, outperforming the S&P 500. So we look at the sector tracker now. The movement of the major sectors over the last 5 days tells more of the cyclical story, right? I can't say that this is the board we want to see, largely because tech and discretionary are at the bottom of the list. But what we've been talking about in terms of having a more balanced approach to equity allocations, I think continues to make sense. If you were all in the Momo growth names yesterday morning was painful. However, if you had a more balanced approach, with some exposure to things like energy, financials, materials, and industrials, a lot of the stuff that we've been talking about since the summer, and gradually building on that, right? Recall, materials and then industrials, and then we were looking at fins and then subsequently energy. A more balanced portfolio did not withstand as much pain or did not suffer as much pain yesterday morning. Middle of the road, staples, comms, and healthcare, utilities, discretionary, and tech, bottom of the list, right? Tech and discretionary. Discretionary now, the two biggest stocks being Amazon and Tesla. Those names have been under pressure of late. So just being mindful of the makeup of these different sectors does become important. Our industry in focus today, speaking of software and services, past 6 months been an outperformer, leading the S&P by 27%. Power bar ratio looks at future potential is strong, 39 to 25 bulls to bears there. Ranked 15 of 21 subsectors. So some top stocks or names to consider as they relate to our power gauge rating: Teradata Corp, TDC, A10 Networks, ATEN, and Progress Software, PRGS, all have very bullish ratings. And all our holdings in a fund that up until the past week has been in a steady uptrend. XSW has a bullish ETF rating and a strong trend as it trades above this rising long-term trend line. You can see the outperformance since last April and continues to be an outperformer, working off an overbought condition and working towards oversold levels as Chaikin Money Flow remains solidly bullish. So interesting dynamic. This is a great example of kind of what yesterday encompassed. You had these expensive growth stocks that have had big runs that may have gotten somewhat extended begin to waver and then sell off hard yesterday morning and then snap back. You're going to see a lot of that. The ARC funds that have become very popular were under a lot of pressure yesterday as well, as that trade was kind of taken off to some degree. But I do think that starts to present some opportunity. Take a look at this fund, right? Pulled back right into a cluster of support and then rebounded. So if I'm looking for ideas as markets are coming out of overbought conditions, I'm probably paying attention to the software space. 39 stocks in that fund have bullish or very bullish ratings, and the fund still is very much in an uptrend. Let's take a look at what's trending now. Yesterday's S&P 500 movers and shakers, the gainers and losers on the day. Winner side of the board, largely levered to reopening, reflation, cyclical rotation, call it what you want. But the theme has been playing out for weeks, if not months now. Marathon MRO up 9.5% following their earnings announcement. Win casino, right? Reopening trade, nothing company specific, 7.7% to the good. MGM, same theme, also caught an upgrade at Argus Research. MGM added 5.5% yesterday. VNO, a REIT, up 5.3%, and Marriott, obviously a hotel chain, up nearly 5% on the day. On the loser side of the board, Leidos, LDOS, earnings report takes 10.3% out of the stock. TDY down 4.28%. Didn't see anything company specific to drive trading there. Disca down 4.25% following their earnings announcement. SBAC, a like amount to the downside, also on earnings. And Dish Network down 4% after catching a downgrade at Pivotal Research. So a lot of moving parts, a lot of activity presents some opportunity for those who are mindful. But again, I think this more balanced approach makes sense. Breadth is getting broader. Kind of redundant, but breadth has remained strong, right? The participation to the upside is broadening out. Leadership is shifting and expanding. So, to be tied to just the growth theme at this point, I don't think makes a ton of sense. Let's start with sentiment now. It's Wednesday, so on Wednesdays we do some sentiment work. Not a ton has changed, largely unchanged from a sentiment perspective. That CBOE equity option put call ratio, the 13-day moving average, was unchanged on the week at 0.42. And even with this sell-off in the high growth names, didn't do much to alleviate this position of excess greed that's been in place since last summer. It just is at this point. We're watching it, obviously, but I've never seen a sustained reading of excess greed as we've seen over the past, I guess it's going on 9 months now within the marketplace. That's all playing out as the VIX remains stubbornly above 20. Everybody's watching 20. A couple of weeks ago, we got a brief close below it. Everybody got all excited, and we quickly snapped back. So VIX back at 23. Sometimes regimes shift, and you move from a complacent, low volatility regime to a higher volatility regime, and perhaps that's what played out following the COVID pandemic. I don't know. We're going to continue to watch it. It's largely unchanged. So we'll look for shifts. You can see bouts that spike towards 40 have been short-lived in the near term. Those have been buying opportunities, i.e. buy the dip in the equity market. So it just is at this point, and we're watching it closely. But for the most part, unchanged week over week. So here's large growth and beginning to lag again. This is the area of the market that's kind of being the most impacted by those rising interest rates. Now take a look at IWF. The iShares Russell 1000 growth ETF has pulled back over the course of the past week and a half, and we're now dancing with a rising 50-day moving average by also remaining well above, quite frankly, the rising 200-day moving average. But look at the relative performance here. We've gone nowhere. Right? Been an underperformer since September, right? Similar dynamic, Q, similar dynamic to the growth value ratios. Kind of pick your way of looking at it, but it all tells the same story, and it's that of a shift from growth to value, a shift that's playing out as interest rates move higher, as economic growth prospects have improved. I think that's a big part of what's going on here as it relates to the rotation trade. Now, we're on a relative basis. We are now testing support, not broken yet, but certainly, underperforming, right? In a choppy relative trend. And then finally, right, in terms of looking for pockets of strength, right? Don't want to lump everything together. Online retail, the Amplify Online Retail ETF, IBUY. Textbook pullback to the rising 50-day moving average, creating this hammer candle here on the day yesterday after the rebound. Just worked off an overbought condition on the RSI, but thus far holding bullish ranges, and a solid outperformer with a 92.6 scooter score. So, there's still opportunity out there. I think it makes sense, right, to have a more balanced approach and not just be all in, all out on one particular theme or investment idea. There's opportunity out there across the board. Ultimately, I think the trend remains to the upside. until proven otherwise. So that is going to wrap us up for today. Head over to ChaikinAnalytics.com/test drive. Take us for a spin. I'll be back with you tomorrow.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.